want. No. So now moving on to the balance sheet. The balance sheet. So the balance sheet basically provides you an idea of where the money is being allocated within the company. So basically, how is all my money being spent, and where is that money coming from? So the balance sheet actually has a very, very important equation. And when I say equation, it's not very mathematical. Accounting is not the most mathematical things, but it's assets equals liabilities plus, sorry for the handwriting, plus equity. So assets equals liabilities plus equity. So basically what that means, assets is everything I own. So if I have a company and I have a computer, tablet, laptop. If I have a computer, or if I have tables, desks, if I have an office, all these things are assets that I own. And everything that I own was either with money that I borrowed, which is liabilities. So money that I borrowed from the bank, from people, so things that I still will have to pay back. That's the point. Or these are things that I own, equity. So basically, I provide equity, which is basically a share of my company. If this pie is my company, I give equity to someone so that they own part of my company, but I don't owe them any money whatsoever because they own part of my company. So there are investors out there who are called venture capitalists or angel investors, and they will own part of my company. They will pay me money so that they own part of my company, and I don't have to pay them back. That's equity. So everything I I'm sorry. Everything I own is either borrowed and I have to pay back, or I own it. So it's my money, it's my company. So that's the most important thing that you need to remember about a balance sheet. So this is normally the balance sheet T. So right here we have two sides of this little table. And right here we have assets. And on this side we have liabilities. And we have equity. And because this is still an equation, remember, still an equation, it has to be equal. So basically, when I come down and I count everything that I own here, all my assets, everything that I own, and I come down to a number, I don't know, lots of numbers here. It's important that, okay, so let's say that, let's give an example that's going to be better. So let's say that my assets are $35,000. So after I account for all the liabilities, everything that I owe, and everything that I own here in the equity part, these two together should give me 35,000. And this is very important. Everything that I own must equals those two. And that's the most basic. And then the balance sheet is very important because, within the assets I can see how much money, I have for in land and property, and how much money do I owe compared to how much money I own in the equity part. So sometimes you'd say that a company is too leveraged because it's borrowing too much money, and borrowing too much money could be dangerous because if something doesn't work out, you're gonna owe a lot of money. So basically, I think that in order to better understand this, we should probably go to an example. So here again, Apple. Here is the balance sheet for Apple Inc. So assets here, we were talking about assets. So assets actually is broken down into current assets, and current assets is basically are assets that are more liquid. And when I say more liquid, it's basically things that I can get rid of very quickly. So, for example, inventory. Inventory is something that I can sell very quickly and I can turn it into cash. So basically, liquidity is how fast I can turn things into cash. Cash is the most liquid asset possible because it is cash. It's as liquid as it gets. Short-term marketable securities, that's something that I can go and sell anytime on the stock market. It's something super easy to get rid of and turn into cash. Inventory, you'd hope that is very liquid. And anyways, you get the idea. It's important to have a lot of current assets because if your company is in trouble, not the case for Apple, but if your company is in trouble, investors like to know that you have a lot of current assets because it's less risky because you can turn all those things into cash very quickly. And as much as you wouldn't like to, think that you'd need to liquidate, that's the whole idea. And then here are some more long-term assets. So these are things that are much harder to get rid of. So property, plant, and equipment. So it's very hard to get rid of land or to get rid of very specific machinery that you use to make your iPhones. Other people won't need that because they're not making iPhones. So goodwill right here. This is an interesting line. Goodwill basically is if you've acquired another company, that's going to go under goodwill. And it's also very hard to sell a company to. So all these things, much harder to turn it into cash. Now, when we go to liabilities, it's the same story. So we have current liabilities, and basically with liabilities, when you say current, you normally would think that you need to pay these back within the next 12 months. So basically, things you need to pay back within the next year or so. That's how you think about current liabilities. Do I have to pay back in the next year? Sure. So current liabilities. Now, long-term liabilities are basically things that you have to pay over 12 months. So you can take longer to pay those. And then that's the whole deal with liabilities. And here, shareholders' equity basically is broken down into stocks. So here are just some very interesting stock information from Apple. You don't need to worry about this. This is very specific. Retained earnings. Retained earnings is a very important account. Very, very important. Retained earnings, basically, remember when we saw the income statement? Whenever you have a net income or a net loss at the end of the term, what happens with that net income? It gets added back into retained earnings. So this account hopefully keeps growing and growing. If you have a net income, it goes into retained earnings, which means you keep growing and you keep accumulating retained earnings, which is pretty great. And then here are other types of equity. So as we said before, Here, check out that number, 305 billion, and I say billion because the whole spreadsheet is in millions. So 305, 602, and then here for assets, 305, 602. Very, very important that these two match.